Hello, my name is Sandra Newman, President and Founder of REAP Financial Group. In our last video, we talked about what I call the ticking tax bomb of your IRA. And most people don't realize the huge amount of taxes that are going to be paid over your lifetime and even over your heir's lifetime on that IRA. There's one way to mitigate that, and that is to seriously look at converting your existing IRA to a Roth IRA. Now, a lot of people get confused and they think that we're talking about contributions to a Roth IRA. Many people are restricted from contributing to an IRA. I'm not talking about a contribution. I'm talking about converting your existing IRA to a Roth IRA. Now, how do you do that? You take your existing IRA and you begin to pay taxes on it today. If we believe tax rates are going up, then it might make sense to go ahead and volunteer to pay taxes now and convert that into a Roth IRA, which is tax-free. Not tax-deferred, but tax-free. Not only your principal, but any future gains are tax-free in a Roth IRA. That could be a very valuable account in the future if tax rates go up, which I believe that they will. So what I want to show you is a strategy for doing a Roth IRA. If you're under age 67, this is a strategy that at least you should consider. I think a lot of people should be doing Roth conversions that aren't. And I understand that because nobody likes to voluntarily write a check to the IRS. But it's either now or later. Taxes have to be paid, and it could be in your benefit to do it now. So what we want to talk about is converting to a Roth IRA. Okay, so what I want to show you here is a hypothetical $100,000 IRA. In the previous video, I hope you saw that, we looked at what the tax implications would be if you did not convert and you began to take your minimum distributions, you died at age 90, the taxes that you would have paid on that are $125,000. Now, if you take that IRA now and you divide it into 4 smaller IRAs, okay, we do this by using fixed annuities because we actually take the gains from those annuities to pay the taxes. So we want to divide it up, and we don't want to try to take off too much of a chunk in 1 year. We want to divide this conversion process over 4-year period. So we've got $25,000, and we're going to convert the first one right away. This is recording in 2011, so we're going to convert that one right away. We're going to convert the next one in 2012, 2013, 2014. This does 2 things. This keeps your tax liability low. Hopefully this keeps us under the radar screen in terms of your marginal tax rate because this amount that you convert gets added to your earned income for that year. So we don't want to bump you up into another tax bracket. So we can play with these numbers and make sure that we don't bump you up into another tax bracket. But by the time you've converted these over the next 4 years, you have paid in a 25% tax bracket, which I think is more reasonable to look at now. You're paying $25,000 of taxes in order to convert that to a tax-free Roth versus the $125,000 that you would have paid if you just let it bleed over the next 30 years. So hopefully that is a strategy that you might be able to incorporate. I think you've got to look at this with your CPA. You've got to be smart about it. You might spread it out longer than 4 years, maybe shorter than 4 years. So folks, I hope that has helped you to see that there are options to being able to diffuse that ticking tax bomb by taking that IRA and converting it slowly over 4 years or maybe longer. This is a hypothetical. You need to have it worked up for your individual situation. I want to invite you, if you have any additional questions or you'd like to explore this option for yourself, I want to direct you to our website, www.reapfinancial.com. There you'll find our contact information. Feel free to give us a call. We'd be glad to talk to you about your individual situation. Thanks for joining us today.